Yo, what's going on? It's your boy Track Investing back here with another YouTube video. We're going to be talking about something interesting today. All right. What is it that we're going to be talking about? The best ICT trading strategy that works 80% of the time. Now, a lot of things that people don't know about this strategy, or one thing is that this is the exact strategy that ICT developed, that if he could teach his daughter one strategy to go into the market, this is what it would be, because he quoted this as, just one of the easiest ways to put it, the most plain and simple way to form a strategy to have profitable returns. And this works about 75 to 80% of the time if you use it properly. Okay. And so we're going to be going over that today. And we're going to break it down into a couple parts. Now, in order for you to understand how to utilize the strategy, there are three main concepts that you're going to need to understand. Okay. So that is three concepts. One, higher time frame bias, drawing liquidity, or let's just call it bias, drawing liquidity. Two, intermediate time frame structure. And then three, the entry model. Secret. So I won't tell you what that is yet, because the entry model is going to be the bread and butter. But without these two things, then you should never take an entry, right? Because a lot of times, what is going to distinguish the accuracy in your entry model is determined by what is happening in the general market. Where is it drawing to? And how are you proving that it is going to draw to that area? If that, this is where it's drawing to, this is the proof that it's getting there. This is the sign to enter, right? And so if you do not have the first two things occurring, then you should never enter, right? Because they trump each other. And just because somewhere is proving to go somewhere, where is it going, right? Like, we don't know if it's proving to get somewhere if we don't even know where it's going. And this is where it's going. This is the final destination, right? This is how we get there. This is the way, this is your entry ticket, right? On the train, right? So this is the train. This is the destination. This is your ticket to get there, right? And so if you think about it that way, right, there's no point in buying a ticket if there's no train. There's no point in having a train if it's not going nowhere. So that's the way you need to think about it, okay? And so we're going to be going over those things today. If you like what you're hearing so far, this is a good time to do this one thing. You can press that like button because that's what it's for. Thank you. You can also subscribe. Appreciate you. You're the GOAT. And also press the notification bell. Really, really appreciate you. And you really didn't have to do that, but thank you so much for doing that. And leave a comment below if you have any questions, and join that free Discord below as well, okay? Now, without further ado, let's get right into the video here. So let's start off with number one. What is meant by bias? Bias is essentially, where do you think that the market is drawing to? And it could either be on a higher time frame, it could be intraday, or it could be intrasession, right? And so, in order to define a bias, you're going to need to understand a couple things. Price is typically drawn towards liquidity and inefficiencies. Okay, so let's break that out. Let's break that out for you. For bias, it's a component of two things. Liquidity and inefficiencies. Bonus concept here as well. Higher time frame trumps lower time frames, right? And so let's start with this part first. All right, let's start with this part first. 1 and 2. I'm typing this out because this is good for you to take notes, okay? You should be taking notes here. Now, liquidity. Liquidity is, essentially buy stops and sell stops, okay? So essentially, those are places in the market where retail traders have orders above those particular equal highs, equal lows, old highs, old lows, because essentially smart money needs to accumulate orders in one area. They need to incentivize 90% of traders to buy in one area so that they can take all their large positions and short into those accumulation of small retail positions, if that makes sense, right? So in the marketplace, there's buyers and sellers, right? How can I buy something if there's not enough sellers? That's why a lot of people will say that the markets are manipulated, because they need to ensure that at a certain level, when price is moving fast lower, retail needs to think about shorting, and that's why smart money is buy low, sell high, so that they can buy at those low levels, because people are going to short into their longs, right? I cannot buy a contract from you if you don't sell it to me. And so we need to understand where are those orders being accumulated, so that we know where smart money is going to attack and ultimately is going to be the best place for you to enter. And so I'll give you a quick example, even on this NQ daily chart, right? And so you see these relatively equal lows right here, right? Relatively equal lows and right here as well. That's what they would call, liquidity, right? So liquidity is under here. Why? Because there are orders below here that are going to trigger people to want to sell, right? It's going to trigger people to want to sell. And so when people are going to sell below here, okay, because and why is that? In retail, they call this area like, it's a zone where, if it breaks out of here, price is likely to continue to expand in the opposite direction. To continue to expand in that direction. So people start shorting down here. But really, what does smart money use? Smart money, it wicks below here and uses an opportunity to reverse and start longing, right? So they long all the short orders that were below here and ended up changing market direction. Right? Can you see that? And now they're attacking all the orders that are above here. If you break this high, people think that it's good to start longing. And so there's a bunch of buy orders above here, right? And so that people can take short. You can see once we purchase high, you can see we're starting to come back into the range a little bit, right? Because we're shorting at high levels and buying at low levels. So you can see a little bit of liquidity activating in the marketplace right now. And another thing I want to talk about is inefficiencies, right? So the inefficiency is like this. So let's study these three candles right here. Okay. In fact, let's actually study these three candles right here. 1, 2, 3. So inefficiency typically means that, market needs to be efficient, right? When you're executing orders, buyers and sellers need to be offering they need to be offering, right? And also selling at different levels, right? For example, if I want to buy a contract here at 21,200, there needs to be someone who's going to sell it to me at that level. If there's no one selling it to me at that level, then the market is not efficient, right? The market should be efficient in the sense that if I want to, if I want to buy or if I want to sell at a certain level, there should be someone there, right? And so when you see candles like this, so this candles, you see this first candle, take a look at this high of this candle. This candle over here expanded, and then the third candle formed. But the low of this candle, it never reached back to this candle's high, right? So what's here? It's just a large volume of buy orders, right? People are just buying, right? And the market is pushing price higher, but there's not really any sell side delivery being offered here, right? Which would be a candle forming in the other direction. That's why you see a lot here. Price is moving efficiently, right? It's moving up and down, up and down, up and down. But when you have a large expansion like this, and you have a separation between this candle's low and this candle's high, you create an inefficiency. This is called a fair value gap. This place is inefficient, okay? And so you can see that price eventually returns back to these levels. You can see it's not a coincidence. Price ran higher and eventually returned back to this zone. And you can see that we are now 1, 2, 3 taps. Bodies didn't even close inside of it. So that's how sensitive. It's not a coincidence that price fell almost, 1,100 points and just randomly stops here, right? This is what you call a PD array, right? This is price delivery, right? That is algorithmic in nature, okay? PDA. And so you can see that it bounces off that level. And so price will do one of two things, right? It'll either take out old highs like it's doing here and taking out the liquidity, old lows, we're taking out liquidity, or we're returning back to inefficiencies. And so when you understand where those zones are, it'll help you to develop a bias. And don't worry, we'll be going over a couple examples today, so this doesn't just sound like a bunch of hoopla for you. Now, another thing to keep in mind is that on top of these two, you need to combine them with the idea of time frame analysis, right? So the daily candles, the 4-hour candles, the 1 hour, the higher the time frame, the more likely that time frame is going to get respected relative to the lower ones. So your bias should always be in line with where the highest time frame is going. That's why you want to study down from the weekly to the daily to the 4-hour to the 1 hour, because higher time frames trump lower time frames. Okay, and so when you are deciding, okay, well, is is, you know, there's an inefficiency right here between this candle's high and this candle's low, right? Just a bunch of up movement. And in fact, there's no body of candles here in between these two candles, right? So that's a volume imbalance. So that price is likely to return back there after purging liquidity, taking out. You see how we're combining concepts too? We purged liquidity above this high, and now we're returning back to an inefficiency, right? And so price is drawing back down to this inefficiency. And what if there's an inefficiency in this wick above here on the 4-hour? Well, this is the daily. So I'm not worried about something coming back up here, right? I'm worried about what the daily is telling me they're going to do, because the daily is going to be, you know, it's what the thing about, like the 4-hour candles are just making up the daily candle. So the 4-hour candles, no matter what's happening in that time frame, is going to draw to what's happening on the daily. Same thing with the daily. It's going to happen. It's going to draw to what's happening on the weekly. Okay. And so that's how you see price drawing back down into this inefficiency. And so on a day like this, you'd be looking for shorts, no matter what lower time frame you're looking at. Okay, so that's what we talk about. You know, bias, strong liquidity, and higher time frame. Now let's get down into intermediate time frame structure. Now, like I said, we know where the daily is going, but we need to be able to understand intermediate time frame structure, right? What does that mean? It means the time frames that are lower than this, it needs to be proving to you that, hey, we are going in line, right? It essentially, yes, the train is going to get there, but it needs to tell you that it's ready to go. A lot of times that the train is not ready to get there yet. You know, it's still getting oiled up. It's still, you know, oiled up is crazy work. Hey, yo, no diddy. But it's still like getting, you know, some gas. It's still, you know, maybe it's chopping around, right? It's accumulating. It's charging up. It's not ready to go there yet, or it needs to go in the opposite direction to go back to the fuel station, and then it'll start actually heading in the right direction of where the bias is going to, right? So you need to get on the train when you're ready, when it's ready to go, right? So if we go like down here, for example, you can see that even though we were right, even though we were bearish on this day, you can see that starting yesterday evening, price is still running higher, right? It's running higher. It's running higher. Even though we have a bullish time, even though we know we're bearish, I need to wait for a clear signature that we're ready to go bearish, right? And so once I see here on the 4-hour, the price breaks above these relative equal highs right here, wicks it, and then creates a bearish order block, I know that now in this smaller time frame, it's telling me that the train is ready to go. Right? We can even look at another time frame here. I like to go from the daily down to the 4-hour, to the 1-hour, to the 15, right? And ultimately we'll get to what time frames we're entering on. But you can even see here, right? We have this high that gets purged by this high right here, comes back into the range, creates this bearish order block, taps it one more time, and starts to run lower. That's how I know that this move in the intermediate term is aligning with what I want to see on my higher time frame. And so when I get down to the 1 minute, the 5 minute, I'll be looking for entries in this candle over here, because I know that now we've created this bearish order block after purging liquidity and reacting from this wick over here, which is really a rejection block. I know that we are ready to start heading lower. Okay. Now let's go back here, right? So intermediate time frame structure, that could also be the 15 minute. Let's just go down to the 15 minute too, right? So here you can see this is around where that 1 hour order block is formed. And you can see that now market structure, instead of creating higher highs and higher lows, right? We now create this long-term high right here, and we end up making, right? We end up breaking market structure below this low, right? So this is now our first series of lower lows, right? Right here. So that means that break of market structure after purging liquidity, and it's now in line. This intermediate time frame is now in line, right, with my higher time frame drawing liquidity, which is the daily or the 4-hour, right? And you can see very obvious relatively equal lows below here, right? And all this trendline liquidity that is now also telling me that this is likely to get attacked, right? And it gets attacked fast, okay? It's likely to get attacked, okay? And so you can see that happens. And then price, you know, returns back to this fair value gap inefficiency, right? So you can see that there's even liquidity and inefficiencies on intermediate time frames, right? So that's why time is fractal. But let's not get too distracted. Let's just stay focused here, because that's a whole different concept. But yeah, you can even use the 15 minute as your daily and trade the 1 minute, right? And you can use the 5 minute as your intermediate time frame structure. Time is fractal, so you just want to have a general understanding of where high time frames are and where they're going and how it informs your day-to-day trading. And so price breaks market structure below this low, returns back to this premium CIVI, and continues to run lower and ends up taking out the liquidity below here, which also happens to have that daily inefficiency below here in this range as well. And so let's go back up here. Now that we understand that intermediate time frame structure, you need to know when the bus is ready to take off, right? When the bus is ready to take off. So let's actually just write that down. Intermediate structure, right? 1 hour, 15 minute, needs to be proving to you we are ready to go in the direction of bias through market structure. And I can do a separate video on market structure. I feel like a lot of people don't really understand like what market structure is really important and what is it really telling you, right? Because it's not just a series of lower lows. I can know even before that low gets taken out that market structure is telling me that we're probably bearish. Like SMT, for example, I can turtle soup that. I don't even need to see break a market structure lower below that low, right? Or there's a bearish order block that forms after taking out a key high, and I know that the bias is lower. So there's other things that we can talk about in a separate video. If you want to see that, press the comment below, but also press that like button just in case you haven't so far. Make sure you subscribe as well. And the last thing here, which is the least important but is the way to get profitable, is the entry model, right? So we'll talk about that. This entry model is actually called the 22 model. So it's the ICT Mentorship 2022, arguably the best series of trading videos on the entire internet. And so that is me. That is essentially the 22 model goes like this, right? So you have, let's say, an old low that forms right here. So there's an old low. And then you have let's do it this way. Let's say you have an old high over here. Let me actually be cleaner because I feel like this is not the right time frame for this. Let me go down to 1 minute. So let's say you have an old high right here, right? And then you have a break of market structure above that high. Okay, so you can even think about it. Let's say we're making a series of lower lows, right? You make a new low below this low, break market structure above this high. So you've been going lower, but then you react off a PRA and then ends up breaking market structure higher. And there has to be a fair value gap. So 3 steps: purge the liquidity below this recent low, break up market structure in the other direction above this high, fair value gap, returns back to that, runs higher. Okay, hopefully that makes sense. So you do that, and that's your entry model. And so essentially, once you've seen that the bias and drawing liquidity has been formed, right, you know where a price is likely to go. You see that lower time frames are starting to showcase to you that, okay, we are starting to follow order flow that is in that direction. Then you look on the lowest time frame you're wanting to trade for that entry model. Okay, so we'll go over a couple examples. Go over 2 examples right now. So one, give me 1 second here while I pull it up. I believe it was on the 16th right here, right? So let's talk about this. It was on this candle right here on the 16th. I'm gonna go all the way down to the 1 minute and show you this trading entry, and it starts in the daily time frame. So there is, if you don't notice, a daily SIBI over here. Okay, there's a daily FVG SIBI right here. Price has just purged these lows. It's now inverted this IFVG. And, at this point, I'm anticipating that now that we're in a premium, because look at this. Recently, we've had this low form and this high, purge this high, came lower, break a market structure, returned back to the SIBI, went lower, made another low, right, and came back higher, did not break this high, went lower, took out this low. So we're obviously bearish. I know this is like a short-term purge of liquidity, but it's not breaking market structure yet. So when price returns back to this premium level here, I'm still anticipating there to be a very strong reaction. I also just made a recent video on how daily FVGs can tend to be very, very sensitive levels. So even if you are long-term bullish, right, after purchasing liquidity, you want to see this side taken out next. Once you get here, you're likely to face a short-time retracement. So I'm anticipating that when price gets to this level, I'm going to wait for intermediate time frame to confirm that once we get to this level, that we're going to run lower. Right, and maybe not run lower for the whole time. Right? We may just have a short-term retracement, and then we continue higher. But right, do you see how I start off on the higher time frame bias? The bias here is that the bias to me, right, is that I'm anticipating, like, what is bias? Whether you think price is going to go up or down. So my bias is that price is going to go down once it reaches this level because it's a daily FVG SIBI and it's a very sensitive level, right? And so once we get there, I'm now waiting for intermediate time frame structure to agree with me. So let's go all the way down to the 16th. 1 second here. Gotta make sure that this level stays with me. Okay. Let's go down to the 4 hour on the 16th, right? Which is right here. So now that we've gone up here, right, on the 4 hour, we've wicked into this old SIBI on the 4 hour, and now we've created this bearish order block. That's telling me that price is now getting bearish. Okay. Let's go another step further. On the 1 hour, it's also intermediate time frame. We've taken out all this liquidity above these highs, purged this high over here, and now we're starting to create down close candle, came back higher, created a bearish order block right here. Okay. On the 15-minute, I can see that all this intermediate time frame is agreeing with me, right? All its immediate turn time frames are all agreeing with me. Bearish order block forms here. Another bearish order block, right? Price returns back up higher, takes out this high, continues to make another bearish order block, breaking market structure below this low, right? I'm starting to see a series of lower lows and lower highs, right? So it's telling me that intermediate time frame structure is in my favor. So every single time that price returns back to a premium array, right, like this SIBI or this old daily FVG SIBI, I know that price is likely to continue lower. Okay. So now let's wait. Let's go for the entry. Okay. And I believe that entry happened like so, right? And now, and when you have this entry, it needs to be within the proper time zones. Okay. So let's look for a proper 22 model entry. Now, this is the first trade I took. Okay. So I took 3 trades today, but let's just go over one. So I know that this is now what, 11 o'clock. This is between the 1050 to 1110 macro right here in this area. And this is the daily SIBI. And I know that intermediate term time frame structure is telling me that we're bearish, and the daily is also bearish, right? So now I'm waiting on the 1 minute to afford me my entry model, which is 22 model. So you have this high that taken out by this high, and we break below this low, and there's a fair value gap right here, right? Now, I'm not anticipating price to return back to this fair value gap once we run lower and break market structure. Why? Because we have this IFVG busy over here that price has already ran through. It's going to leave this, it's likely to leave this open and act as a breakaway gap. So once we break below here, I know that I have 3 qualifiers for my entry. And normally I want to wait until it gets back to fair value gap to enter. But if I'm not anticipating that to happen, then I'm just going to get in as soon as I have my 3 parameters validated. So once I saw this break and this candle close, I'm entering pretty much here on this candle. My stop is above this high, right? Or if you want to be a little bit more refined, you can place it above 3 repeated arrays. You have this bearish order block, IFVG BISI, and you have this SIBI in place. So I leave it above this SIBI's candle, right? And where do you aim? You can aim below these relatively equal lows below here as well. Nice 1 to 2.5 right there. That's one example of a very profitable 22 model. Okay. And we can do one more example as well. And I can actually walk you through it live because I have it recorded. All right. So at this point, to explain the logic behind this trade, okay, if you look over here to the right, on the daily and the 4 hour, I can't, I don't, there's no need for me to really go into it, but there's a 4 hour volume imbalance above here that is also overlapping with the new day opening gap. Okay. Now we have liquidity above this high over here and above these highs over here as well, which is the Asian and London highs, right? And this is around what time? This is around entering into this is right post the PM session. And this is the daily profile, right? So I'm developing bias. Like my bias, I'm trying to understand, should it be bearish? So I know we're in a premium. So like when I'm saying bias, it's either going to go up or down. So I know, and now so I'm thinking, what can qualify for it to keep going up, or is it going to go down? So I know that one, it's reacting from a 4 hour volume imbalance. I don't have marked here on the chart, but just assume it's right here. A 4 hour volume imbalance, PD array, basically acts like a SIBI or FVG. And there's a new day opening gap there as well. That's not on this chart, but it's the same chart. And so it's reacting from PD array in a premium. It's purged liquidity, right? So it's going to be seeking out the next targets for liquidity you can take out, okay? Or inefficiency you can draw back to, okay? And, that's what makes me believe that we can go down. Now I'm waiting for intermediate time frames, so time frames in between the 4 hour, right? And, the 1 minute where I'm going to enter that agree with that. And so you see here on the 15 minute, that price is wicking continuously. Once it wicks in like this, right? And it returns back lower, it's telling you that, okay, we're just purging liquidity. We're probably going to have a short-term retracement, right? Because think about it. This wick is going to be hard for price to get through. Like it's going to react off this wick and continue to run lower, right? And when you wick something and you come back in, it's telling you I'm not ready to just expand through it. I'm reacting from somewhere. I'm going to run lower, okay? So the 15 minute right here is agreeing, right, with the 4 hour. The 5 minute, right, we create a wick up here, tapping the new day opening gap, and then we create a bearish order block. So the 5 minute is also agreeing as well. So now I have two of my top parameters in an agreement, and I'm waiting for a 1 minute entry. So this is the 22 minute right here: high, low, higher high, break of mark structure, fair value gap. We return to the fair value gap. I enter at 50% of this move. Why? Because I anticipated it to be a pretty choppy session. Price action today has been pretty garbage, so I'm not gonna go for aggressive entries. I want to see price pull back a little bit. Plus, we had like a close. We didn't close below this low. We just wicked below it, so it's likely for us to have a pretty deep retracement. So I enter at the 50%, and I go for a 1 to 3, and let's see how it goes. Right? Once we create this bearish order block right here, I move my stop above it because honestly, it's retraced back to a premium. I don't want to see price go back there anymore. So it's created this bearish order block after retracing to the premium and coming back to this old inversion fair value gap. I want to see price run lower. Plus, we created this FVG CIBI, which is really a displacement fair value gap right here. That I either want to see price come back and tap one more time or stay open. So price actually ends up returning back to that fair value gap one more time, and I get one quick entry. I get another entry right there because I'm still anticipating price to run lower.
Order filled.
All right, so my order gets filled there. And then let's see how the rest of the trade pans out. We create another bearish order block. My stop loss goes above there. Right, we're reacting off inefficiency. That makes that an intermediate term high, and I don't want to see price keep going up there. Right, and then we continue to follow bearish order flow. You see this old wick over here. I like how price is hovering in the below the constant encroachment of that. Okay, price starts to expand away. Right, equal lows here, equal lows, relative equal lows below here as well. I'm cycling through time frames. Now at this point, there's an old 4 hour FVG here. It's an inversion fair value gap. And I know that there can be high resistance here. Plus, I have to go to a doctor's appointment at this point. So I end up actually, I believe, closing out of this trade. I already had a 1 to 3 here, so I didn't want to wait. So hopefully it's relative equal lows, especially because it's another 4 hour level. And 4 hour levels can be pretty sensitive. Anyway. Amen. All glory to God. Christ is King. Once you get to consequent encroachment and we start to run higher like that, you close above this CIBI right here. I know I'm about to go to this doctor's appointment. Like I would want to see price just continue to slam lower. Or if we have some retracements here, I can't hold for that. I'm going to leave. I'm still in the trade there, as you can see, because I like that reaction off that CIBI. But then price, I believe, ends up breaking market structure above that high, right? And then I end up getting out. Okay. So that's an example, 2 examples. Hopefully you learned something today. If you liked the video, make sure you press that like button, and I'll see you guys in the next video.